just logging in late or for the first time, my name is Fausto Pugliese, President and Founder of Cyber Trading University. And once again, I'd like to thank everybody for coming today. Hope you guys learned a lot. We have two more great speakers. We got MTI coming up after Rob Booker, but Rob Booker, once again, one of my all-time favorites. I always like to listen to his conversations. In a way, I learned something new from Rob. We do some speakings together at a lot of the Traders Expos. We see each other time to time. I know he does a lot of traveling and has been all over the world, and also has a great book also, which all of you guys should look at. But he's going to talk about the Forex market, but not only Forex. I would say Rob Booker is also a very good psychologist too, talking a little bit about psychology, because trading does have a lot to do with that, and you can apply it towards anything: stocks, options, Forex, futures. So don't want to take too much time away from Rob Booker. Like I said, you're probably very familiar with him. He's a very, very popular speaker. And once again, we're always thankful to have him to come on Cyber Trading University. So I don't want to take too much time away from him. Rob, let me pass you the mic, and the stage is all yours. Everybody enjoy the presentation. Yes, it's being recorded. Just going to wait for Rob to turn on his mic. Hold on one second, everybody.
So I just unmuted myself. How's that sound?
There you go, Rob.
That is fantastic. I've got one thing in the world of technology that worked for me today. I'm going to quit. That now concludes our presentation. All right, so I'm going to share my screen, and then we're going to just get this. We're going to get this business going. And I want to know, can you see my screen? It should be coming up shortly. How does that look? Can you see the beginning of my PowerPoint presentation, everyone? Yes, I can see it. No, that's really not a real person. All right, Doug says, yes. Hi, Carol. Hi, everybody. I am super happy to be with you today. My name is Rob, and that link will come up again later on today. We actually don't need that link right now. I'm Rob Booker. I put an extra O in my slide presentation by mistake, and I apologize for that. I run a website at tfl365.com, and I'm also a writer, and I am a trader. In fact, let's take a look at my trading account. Why not, right? Let's take a look here. This morning, all right, here's the bad news. The bad news is I'm currently losing $12,924. I have a losing position on the Canadian dollar Swiss franc, which is going to make me a bucket load of money later on. I'm doing pretty good on the dollar yen. I'm going to hold that maybe for all year. That might sound like a joke, but it's not. And I'm currently short the pound Canadian and ready to shoot myself in the face over that trade. And I'm very much unhappy about that. I closed a euro dollar position this morning. That did quite well. And so it'll all even out, and I'm going to be okay. Thanks, everyone, for worrying about me. I appreciate that. I just want to start things off today by telling you that I'm definitely more excited to spend time with you than you are with me. And I hope that in the next 45 minutes or so, 50 minutes, I can share something with you that's going to make a positive difference in your trading. And that would please me greatly. We're going to talk about the stock market. We're going to talk about the currency market. We're going to talk about the futures market. We're going to kind of do an overview of a couple of different trading systems which act as mirror images of each other. And I am going to depend on, oh, that's a beautiful picture of me sitting in a Starbucks in California. That's not what I intended to say. Those are some pictures of things that I've done. I'm the host of the Traders Podcast. I am the author of Adventures of the Currency Trader, which is the greatest book about currency trading ever written, except for all of the other ones. And I am going to talk about some proprietary indicators today. You can get these indicators at tfl365.com. And for those of you that are wondering, yes, that was my live account. That was not a demo account. Here I am in my demo trades. Welcome to the presentation today. And I'm doing a demonstration. This is not a demonstration presentation, so I'm not going to show you my demos. In my demonstration trading account, I'm down $1 million. I'm currently losing everything. But that was my live account, yes, and I'm actually in a bunch of losing trades right now. They are going to be, yesterday they were down $25,000, and they made a $27,000 swing in one day. I'm not accustomed to that big of a swing, and I did have to wear an extra pair of pants yesterday because that was not my favorite day ever. But those trades are doing much better than they were yesterday, and they'll do much better tomorrow than they are today. I'm going to share with you some strategies today that do require proprietary indicators, but I'd like to give you those indicators for free. I'm not really concerned about whether or not you pay for those indicators. I'm just concerned that you can follow along in the presentation today and that you know that I care about you getting in on some of this action. So I am going to talk about pivots and divergence. And if you go to TFL365.com today, those are free. Right on the home page, there's a link to those indicators at the very top of the page. No commitment, no money down. I'm going to get you into this baby for no money down and no closing costs. Once again, the indicators are free. Once again, for all of you that are wondering if this presentation is being recorded, I'm sure Fausto never gets asked that question. Yes, this is being recorded. We are happy that it's being recorded because I'm going to try to talk as quickly as possible so we can get through as much information as we can. We're going to try to do some hardcore technical analysis here. In other words, I'm really going to try to pack in information that's like the stuff that you might ordinarily have to pay for at the end of the presentation. And for the system that works, just kidding, these indicators that you can download are available for eSignal, TradeStation, NinjaTrader, MT4, and my personal favorite, TradingView.com. The indicator is free to download for the first 4, and it is a small subscription cost on TradingView.com. We're in the works on building that for Thinkorswim. Building indicators for Thinkorswim is like tying a jetpack to the bottom of a Model T. Henry Ford didn't want you to do it, and I don't want you to do it. It is destructive to your mind and body. Thinkorswim was designed for execution and awesome trading. It sucks donkey nuts for developing customary indicators. And I'm sorry. I found a developer who would finally do it. He asked me for $2,000. Since I give these away for free, I told that guy that I hoped that he would get hit by a truck, because I wasn't going to pay that. All right. Once again, the indicators are available. Nobody asked me this question again. I don't want to talk about it again. I just want to talk about the meat of the presentation. That was the bread and like the condiments. Now we're going to get into the meat of this sandwich. Pivot points are generally freely available on your charting platform. My favorite price for everything in life is not necessarily free, but free is very high on the list. And you can download the indicator to get the pivots that we're going to use, or you can just simply open up your charting platform and plop up the pivots. They're freely available. It's nice, right? On the chart in front of you is a picture of JCPenney. You know, hire Apple's retail executive and watch the stock price dip into the low zeros, right? But JCPenney on this screen isn't a story about fundamentals. I don't care about their earnings. I don't care about their coupons. I don't care about their ugly clothes. I happily bought every merit badge I ever earned as a Boy Scout, which was won at JCPenney. I remember my mom taking me into JCPenney and looking in the Boy Scout merit badge section and very much not enjoying myself, as all my friends were around me looking in the stylish jeans section and I was picking up stuff for Boy Scouts. Not the best. So on the screen in front of you with a red arrow pointed to it, you can see a pivot point. It's in green. There's a whole bunch of other lines on the chart, and we're not going to pay attention to those right now. We're going to focus our attention on the pivot point, which is green. That pivot point is going to be the basis for much of what we talk about today. These are minutes you can never get back. I'm stealing minutes from your life right now. It's quite enjoyable. You can never get these minutes back, and I'm going to try to make these minutes profitable for you so that you spend 45 minutes with me, and then you'll make enough money from what we learn about that you can get the psychological therapy and counseling you need to overcome whatever damage I've done to you during the presentation. Plus, you could still have a little bit of money left over to support your ex-wife and the family. And then maybe at the end of the day, you can get yourself an ice cream cone or something. That's pretty much what the goal of the presentation is. And the pivot point is where that all goes. And if you're not enjoying the humor, I'm so sorry. Mostly for you, but I'm also sorry a little bit. Pivot points are essentially the average of something that happened yesterweek, yestermonth, or yesterday. For example, if we're going to look at a daily pivot, the daily pivot is calculated from the high plus the low plus the closing price from yesterday's market divided by 3. A pivot point that's a monthly pivot point would be last month's high, low, and close divided by 3. Now, I know that's a lot of basic information for many of you that are here. And for those of you that are advanced traders, I appreciate you kind of patiently waiting for me to get to the the bulk of the presentation, but I really try to concentrate on one system, usually in a presentation, and I got to lay the groundwork before I can do that. The problem is, today I want to talk about two trading systems, and to do that, it's going to require me to get into a little bit more of the fundamentals that some of you might already be familiar with. So that's how a pivot point is calculated. Pivots can be daily, weekly, and monthly. Once again, if it's a daily pivot that shows up on the screen today, that pivot point is yesterday's high, low, and close added together divided by 3. If it's a weekly pivot that appears on a Monday, it's last week's high, low, and close divided by 3. And if it's last month's pivot, then it's last month's high, low, and close divided by 3. Here's JCPenney again on the 15-minute chart. This could be the euro dollar, it could be oil, it could be gold, it could be beans, it could be feeder cattle, frozen orange juice, or any other of those crazy financial instruments that those of you that are futures traders trade. I wonder how many of you here trade options. If you trade options, raise your hand. Wait, I can't see that. You're not sharing your screen. What about those of you that are trading options? Anybody here trade options? Anybody like to get in on the options action? Anybody love to hear, does anybody here get all sort of tingly in their nether regions when I say iron condor or butterfly bull spread? All right, there you go. What I'm going to talk about today is going to bring you some happiness and peace of mind. True happiness, not the kind that Obama promised to bring you, but real peace of mind and happiness. I don't know why I said that. All right, hold on. I love options. I love pivot points, and I love the currency market, and we are going to just nail this stuff to the wall today. And you're going to need to remember the basics here, because I'm about to get into the deeper part of the presentation. And that weekly pivot that you see on my screen up there, for those of you that are beginners, you're going to have to make sure that you concentrate on that level. You've got to pay attention to this. And I don't mind repeating myself to someone I'm dating, not to you necessarily. So I don't want to answer this a million times. Pivot point is in green. That's a weekly pivot. So if that's a weekly pivot, that is based on what? Fill in the blank. That is based on the high plus the low plus the closing price of what? Last month? Yesterday? Last week. Herman. Boom. Boom shakalaka. Marion. Nice. Hi, Marion. Good to see you here, Marion. I'm not even sure I know you. Hi, Carol. All right. So some of you are answering incorrectly just to give me a hard time, and I think that's hilarious. The weekly pivot is based on last week's high price plus the low price plus the closing price divided by 3. And then it just ends up as a line on your screen. If it's a weekly pivot, it appears on Monday based on last week's information. So every Monday you get a new weekly pivot. The weekly pivot is the same length as Monday to Friday. So the length of that pivot from left to right encapsulates Monday's price movement all the way into Friday's price movement. So, you know, for a lot of you, the hours in which you are sober, because then comes the weekend and you're not sober anymore. So the pivot encapsulates all the price at which Marion is sober. I'm just kidding, Marion, joking around. On the chart, you can also see S levels and R levels. These are traditionally included in most pivot point packages, and they are shown on your chart as resistance levels and support levels above and below the weekly, daily, or monthly pivot. We're not going to care about these. We're going to ignore those levels altogether. They may be found on your screen, but you want to ignore them. The pivot point you don't want to ignore. You do want to focus on the pivot point, but all those other lines on the screen, we're going to ignore those. Next, now we're getting a little bit deeper into the conversation. We're going to move from the general to the specific. And what you see on the chart now is that same old pivot up there at the top in green. It says missed pivot now. And then there's a pivot below it, also identified in green with a red arrow pointed to it, and it says hit pivot. Between pivot points that are touched and pivot points that are not touched. Here's the difference, and it means a lot. It's a big deal, and for those of you that are options traders, I definitely want you to put down the crack pipes for just 1/2 of 10 minutes and hear me out on this, because this is going to change. This is going to change the way you think about the market occasionally, and I think it's going to make a positive difference for you. That's the only reason I'm really here today, because I love you guys. I love traders. You're my favorite people in the whole world. A missed pivot identified in the upper left portion of my screen is a pivot point that was not touched by price in the week that it was created? And Janet, I can appreciate that. I know that not all of you are crack smoking alcoholics or anything like that. I didn't mean to make any. I'm sorry. I shouldn't have said that. All right. A missed pivot was not touched by price in the week, the day, or the month that it was created. You'll notice on the screen in front of us here that missed pivot, that one at the top left, was not touched by price during the week that it was created. You can see that price stayed below that pivot all week long. Because that pivot was not touched during the week that it was created, we call that a missed pivot. Somebody on Twitter, on the Twitter, my mom calls it the Twitter. Are you on the Twitter? Yes, I'm on the Twitter, Mom. You don't want to get on the, you don't want to see the stuff I post on the Twitter, Mom. Somebody called it Miss Pivot. They said, who is Miss Pivot? I thought that was absolutely fantastic. Miss Pivot was not touched by price all week long. I mean, she wants to be touched. So missed pivot was not touched by price during the week that it was created. This is super important, and it's going to be the crux of the issue and the center of the sandwich. It's the meat of the sandwich, and this webinar is now kind of like a sandwich. All right, the hit pivot is down below. You want to hit that pivot, right? That pivot wants to be hit. Every pivot wants to be hit in the week that it's created. Now, I have a lot of statistics, some of which I'll share with you in the webinar today, some of which we will not have time to get into. But a hit pivot is a pivot that was touched by price during the week that it was created. So you can see here that on the screen in front of us, you could see price or candles touching that green line during the week that it was created. Now, how do we know it was touched during the week that it was created? Because the price is touching the green line, and we know that that green line is probably Wednesday or Thursday because it's the middle of the line. So that's the, we're talking about setting up trades based on whether a pivot was hit or missed, and you're going to need to know whether something's missed or hit. Now, someone just asked a really interesting question. They said, Rob, are you talking about setting up trades that only start on Monday and refer back to last week's pivot? For the presentation today, the answer is yes. Yes. That is absolutely correct. Now, I have something special coming out tomorrow morning. I couldn't get it ready in time for today. Something really special coming out tomorrow morning that trades at midweek, but I'm not ready to share that with you just quite yet. And we'll get in on that action in a little bit. Okay, you know what a missed pivot is? You know what a hit pivot is? Let's talk about a trading system. A missed pivot, once again, is a pivot that was not touched by price during the day, week, or month that it was created. A pivot is only calculated one time, and then it stays on your screen. It never changes. It doesn't dynamically recalculate itself. It's not a Camarillo pivot or a Lando Calrissian pivot or a Fibonacci pivot or a DeMark pivot or whatever. It's a missed pivot. It's a standard pivot. A pivot is not touched by price during the day, week, or month that it was created is a missed pivot. That's important. And you only know that the next day or the following week or the following month. It throws away a lot of the stress to this because you're just waiting. It's kind of nice. A missed pivot can do a lot of things. I spent 7-8 years of my life now calculating and doing statistics related to pivot points. A pivot point can be used for a lot of different reasons. It can identify an emerging or a new trend. It can be a profit target for a trade you're in. It can be a stop loss for a trade you're in. Some of us don't like stop losses that much, and so don't really care. It can also, however, suggest a trend reversal, even a brand new trend. So sometimes a missed pivot is a sign that the trend could turn around. It could also be a profit target. And that's how we're going to focus on a pivot to begin with. At the start of a new week, identified by the red line that you see running up and down vertically on the chart in front of us, you'll notice that it's a new week. How do we know it's a new week? Because the pivot ended and a new one began. We know it's a new week because the end of a pivot line happened. We also know that Apple rose upward during the week and it did not hit its pivot. Now, that means the pivot is what? Hit or missed? And I know this is a basic question for some of you, but for some of you, you're trying to catch up, and I care about you guys and gals. It's missed. Marion, boom shakalaka. Nice job. Noel, nice job. No, Edward, Edward Cullen. Edward Cullen is not here. Just kidding. Steve. Edward Cullen's like, I've been alive for 1,000 years. I'm going to finally go to one of those Rob Booker presentations. That's pretty awesome. All right, it's Patrick Cullen is here, and Edward, someone else is here. That's awesome. So Edward's brother Patrick is here. I will see you late tonight. Okay, love you guys. That pivot is missed. The new week has begun. It's Monday. The start of a new week signals it's time to trade the pivot. Here's how we're going to do it. That pivot has been missed, so that's going to become something of a target. A missed pivot can suggest that that upward trend on Apple is going to reverse. So what we're going to do is on a regular basis, you and I are going to look at 15-minute charts. We're going to look at Apple, Amazon, LinkedIn, WhatsApp. Just kidding. Don't you think that the guys at Instagram are like shooting each other in the face right now? Wow, we just took $19 billion less than we could have. We're going to look at the 15-minute chart. We're going to look at Apple, LinkedIn, Amazon, Microsoft, whatever you want. It doesn't matter. I would prefer that it's a healthily traded stock, something in the S&P 500 preferably. That would be good. We're going to look for missed weekly pivots, and we're going to give it 2 weeks to get back to that pivot. If you are an options trader, what I'm going to talk to you about right now is going to be super awesome. If you're a currency trader, this is totally going to apply as well, but you're not going to use an option. If you're an options trader, you're going to use an option for what we're going to talk about. And you're going to, those of you that know how to do spreads and bull spreads and bear spreads and condors and giraffes or whatever else they have in the world of options trading, you people are messed up. You're going to use that. So this is going to apply to just about any market that you want to trade. It's not going to matter. And here's what we're going to do. Here's the system, and I can show you the system in one slide now that we made the foundation. So instead of trying to pack a bunch of information that's pretty much useless into your brain, which is what generally I try to do, today I'm going to try to focus our attention, and I'm going to try to be less of a spaz, and I'm going to try to leave you with something that you can walk away with and make some money with. Now, like now, then, future. Apple on the 15-minute chart starts a new week. It's Monday where that red line is drawn up and down vertically on the chart. Because it missed last week's pivot, we know it was missed because it wasn't hit by price. We colored it green to identify it on the chart. Apple is going to make an attempt to go back to that weekly pivot. Now, if you're an options trader, you're going to know how to do this much better than I am. I don't call myself an expert at anything. But as an options trader, what you're going to do is you're going to buy some time here. And what you're going to say to yourself is, within 2 weeks, price is going to make an attempt to get back to that missed weekly pivot. 70 to 80% of the time, and it's going to depend on the financial instrument you look at. If you start looking at penny stocks, it's going to be 50% of the time. If you start looking at Apple or Amazon or LinkedIn or some technology stocks, it's going to be closer to 75% of the time. Price will return within half the distance. It will make up half the distance to that weekly pivot. What this means is you could sell a call, you could buy a put, you could do some kind of a spread where you sell one option to help pay for another, and you make an attempt to get back to or toward, maybe not all the way, to that missed weekly pivot. Once again, we're not making a guarantee that that weekly pivot will be hit within 2 weeks. Let me repeat that again because that's really important, and I know that I'm speaking quickly and there could be a misunderstanding. It is not a guarantee that price will return to that weekly pivot. However, it is probable that price will return to that weekly pivot or halfway the distance to that weekly pivot within 14 days or 2 weeks. If you are a currency trader, what that means is you can sell toward that weekly pivot and then start making some profit and then move your stop loss to break even and then close the rest of the trade when you get to the weekly pivot. If you are an options trader, what it means is in a bull market or a bear market, it doesn't matter. Apple was in a bull market and Apple missed a weekly pivot, and buying a put with an expiration of 2 to 3 weeks with a strike price that was already in the money. So if you sold a put, if you bought a put that was already in the money, I'm not talking about buying far out of the money options and buying a lottery ticket. I'm not into that kind of stuff. I'm talking about taking the probabilities and making some money from it and then closing it out and going and spending the money like everybody knows that you want to spend it on, you know, movie tickets or something, whatever you want to do. Buy a put here, you buy a put that's in the money, and you let that drift toward that missed weekly pivot. Once it gets halfway the distance to that weekly pivot, you want to start taking some profit off the table and let the rest of it roll. Let's look at some more examples. You could buy or sell the stock or the currency pair, or you could buy or sell an option assuming it's reasonably priced. Now, for a lot of people, a reasonably priced option is an option that's pretty far out of the money, and they feel like that option is going to appreciate in value significantly. I actually think that options are priced reasonably when the price of the option moves in line with the price of the underlying financial instrument. I'm not into losing money. I hate losing. I'm really good at it. I mean, my entire high school career is proof of that. I went 0-1 in wrestling, and the only points I got was when the guy threw me outside that little circle. But then, after a few minutes, I was like, I'm in here wearing earmuffs and a leotard, wrestling with a sweaty guy. I'm like, this is over. And I don't know why I brought that up. Anyway, back to trading. Let's look at some examples. Here's Apple on the 15-minute chart doing the opposite. Apple fell below the weekly pivot that you see on the left-hand side of the screen. And then it missed another one the very next week. Then the week later, you can see a red arrow moving up on the far right-hand side of my screen where Apple made an attempt to get back to that original missed weekly pivot. If this were a currency pair, we'd be buying the currency pair and attempting to get back up toward that missed weekly pivot. That trade would end up being profitable. We might have to take some heat for it, but that trade would end up okay profitable. The wonderful thing about buying a call on Apple that was already in the money, the Monday after the first pivot was missed, and then buying another call that was in the money the next Monday after the next weekly pivot was missed. The beautiful thing about that was, within 2 weeks, that call became worth a lot more. In fact, it became worth a significant amount more because it was going to track with price more effectively than something that was far out of the money. Now, for those of you that are intelligent and sophisticated and experienced options traders, you're going to know how to do this better than I just described. I don't purport to be an expert in options trading. I don't want you to think that I just said that I was. But I am an expert in this strategy, and I know it works, and I make some money from it on a regular basis, and I think you can too. You get the picture here? You miss a weekly pivot, guess what price wants to do? Price wants to go back to that weekly pivot. Here's Microsoft on the 15-minute chart. Missed weekly pivot on the left-hand side of the screen in green. You can see it here. I don't know if you can see my mouse, but I can maybe even try to draw with a pen on it. There we go. So Microsoft misses this weekly pivot. The week ends, and on Monday, you're going to buy a put, or if you're a currency trader, you're going to set up a sell trade back toward that weekly pivot. Now, all we need to do is get halfway the distance to it in order to start making some money in most cases. In a lot of cases, I'll just take the profit halfway the distance to the weekly pivot because I don't know if it's going to get all the way there or not. Then 2 weeks later or 1 week later, so we skip a week, and then this pivot is missed. This weekly pivot is not hit by price during the week that it was created. The Monday after, so Monday rolls around, there's the division, it's Monday now, and on Monday we buy an option or we buy Microsoft, and Microsoft is going to make an attempt to get back to this level. It's going to probably get halfway the distance to that level, and it might even stop working halfway the distance there. Let's look at LinkedIn. I told you that LinkedIn's a good one for this. It's a very good one. So here's a missed weekly pivot right here. Then Monday rolls around, and we're going to buy a call. Now, what happens here? LinkedIn falls. A lot of people don't want to show you the trades that don't work. I'm more than happy to show you trades that don't work. All right, this one didn't work. This didn't work. This option, if you only had 2 weeks before expiration, that first option, option number 1, is going to expire worthless at the end of that 2-week period. If you bought LinkedIn, not a bad idea. If you bought LinkedIn, then you can just hold on to it until it recovers, and you've bought a reasonably well-managed company, and you've bought into something. Now, if you bought an option, you're not worried about the stop loss. If you bought the stock, I want you to give it 2 weeks. The stop is time-based. It's not stop-loss based. Usually they say, you know, the guy gets on and he's like, you know, in the voice of Raymond Tusk from House of Cards, he's like, Frank, you put your stop loss below the low, Frank. You and Claire got to stop out of the trade. I don't like losing, Frank, right? So that's your Raymond Tusk stop loss. I don't like losing, Frank. But you're buying time here and you're buying probabilities. You're not buying a system that says a stop loss below this level is going to work every time. What you're doing is you're buying LinkedIn, which is a reasonably well-managed company. Reid Hoffman's pretty awesome. And you're buying the time necessary for it to get back up to this level that has a probability of success. Now, after 2 weeks, if this doesn't work, you can give up on it. You can let your option expire worthless, and you're fine. Now, the next week after, 2 weeks later, it misses another weekly pivot. And Monday rolls around, and we buy it again. Frank, we're going to buy another option on LinkedIn, Frank. And so you buy another one of those suckers, and this time, I'm going to say all kinds of things that people who are supposedly here to be safe are going to not tell you. I might go in with double the trade size the second time. I'm not here to tell you what I don't do or what makes me sound like I'm safe or whatever. I'm just going to tell you what I do. I'm going to go in with a double trade size, and I'm going to double up on that. Why is that? Because I want my money back. Somebody steals from you, what do? You thank them for it? No, you beat the tar out of them. You punch them in the face, right? Well, maybe you don't punch people in the face. Maybe you're a pacifist, but that's fine too. I mean, I forgive a lot of people too. I'm all into that. But listen, I want my money back. And so that's what I'm going to do to get my money back. I'm going to go in another time on that LinkedIn, and now I've got 2 profit targets. It probably wants to get to the halfway distance to the original missed pivot, and it definitely wants to get halfway the distance to the new pivot. And now I've just drawn all over my charts, and this doesn't make any sense anymore, and we need to move to the next screen. This is Amazon.com. Amazon runs the world, as you know. And I like Amazon. I love Amazon as a company. I love the fundamentals. I read the book about Jeff Bezos the day it came out. I read that book. I got it on my Kindle, and I read the shiz out of that book. And every time in that book where they talked about Jeff Bezos being just an animal and an angry man to his employees, I just thought, that guy's got it. that guy's running a company to make money, right? Not make friends. That's the kind of trader you want to be too. I don't like being that kind of a person. I like being loyal to my friends. I don't like treating people that way. But what I love and admire about him is his drive to succeed exceeds his desire to please other people. That's an admirable characteristic in business. And he's really clearly a loving husband and father. So, you know, he more than makes up for it in the lives of the people that he's with forever. The reason I say all that is that Amazon has great fundamentals. It's a great business model, runs all of Netflix's traffic, runs my email servers, hosts tons of websites. Most people don't even know that kind of stuff. Amazon also is one of the world's fastest growing retailers. But Amazon missed a weekly pivot. Amazon misses that weekly pivot. I don't care about Jeff Bezos, and I don't care about his family, and I don't care about his business. I care about the stock making an attempt to get back to that weekly pivot. I don't care about the fundamentals. Right? Stocks are fickle. Stocks change their mind tomorrow. Stocks are up, next day they're down. Stocks miss a weekly pivot. What is everybody in the world right now doing? In this case, buying Amazon at the end of that week. They're euphoric. CNBC is going to do a special. CNBC special coming up. Can Amazon buy America? Right? Like, that's what everybody's thinking in that moment. You know what I would want to do right here? I would want to sell a call. Why? Because the calls are going to be grossly overpriced right now. Because it's just the volatility is up, so the option's going to be expensive. The price is just zooming up, so the option's going to be expensive. I'll sell the shiz out of that. I'll just make some premium. Give myself a couple weeks for that. Price is going to make an attempt to get back to that weekly pivot. It's going to make an attempt. Now, Amazon within 2 weeks isn't going to get back all the way to that weekly pivot because Amazon is a well-run company. Doesn't mean the probabilities change. All trends have impulses and corrections. You're trading the correction. All right. Frequently asked questions. What about monthly pivots? Could you do this with a monthly pivot? Yes. Yeah, you can absolutely do exactly what I just talked about with a monthly pivot. Another question that I get often is, what time frame chart should I use? Well, the pivot's not going to change its location based on the time frame of your chart. If you look at a 15-minute chart, the pivot's in the same place as it is on a 1-hour chart. Someone said, did you mean say put? No, I said at the top here, you're going to sell a call. Why? Because we don't think it's going to go any further. So you're selling the call. You're selling the move. And you're getting premium in exchange for that. It's going to be a super high overpriced option at this point. All right. Back to time frame charts. If you're going to use a weekly pivot trade, you're going to look at a 15-minute chart. If you're going to use a monthly pivot trade, maybe look at the 1-hour chart. That works quite nicely. Here's one monthly example. Amazon on the 60-minute chart. So the 1-hour chart for monthly pivot. Misses the monthly pivot. This is the monthly pivot for the month of December on Amazon. Once again, Amazon finishes the year, ends the month of December, and it's missed its monthly pivot. The monthly pivot is below price. What do we want to do? What do we think Amazon's going to do? If Amazon misses its monthly pivot, what do we think it's going to do? That's a question. If Amazon misses its monthly pivot, what do we think it's going to do within 2 months because it's a monthly pivot? And I'll wait for some audience participation here. Got a lot of you talking to each other, which I think is just absolutely fantastic. It's going to drop, Jim King says. Jim, you're dead on correct. Absolutely right. Absolutely right. Hey, Monty. Hey, Herman. It's going to go halfway, and Herman gets the award for the best answer. It's going to go back. It's going to fill that space. Halfway the distance is all we need. This is a longer-term trade. This is a much longer-term trade. So you might sell Amazon, or you simply might buy a put or something like that. And Amazon actually ends up falling much further than the location of its December monthly pivot. So if you bought an option and gave yourself a couple of months, that option is going to be hugely more valuable than what you bought it for. And that's an example from the monthly chart. Now, I've only shown you a few examples, and of course, you've got to go home and you've got to do your own research. It's typical in a presentation like this, if I want to sell you something at the end, that I'm going to talk to you about how much money you can make. Let me just stop a minute here and say, a lot of people have lost a lot of money thinking that what I said that something was a sure thing. You better believe that I will put my real money on this. And if any of you trade options and you want to be in touch with each other and you want to trade these together, listen, I'll put my own money in on this. I'm ready to go. I have no qualms about it. I'm qualmless. I have a qualmless attitude about this. I have no qualms are found within my heart about this. But you, of course, have to do your own research and your own due diligence, and you got to investigate which financial instruments might make the most sense for you to trade. All right, we're going to look at some examples from the currency market now. Now, I'm a currency trader. I have been for 14 years, and that's never going to change. And we're going to look at some examples. We're going to concentrate on the currency market for a few minutes here, and we're going to look at daily pivots. And we're going to talk about something exactly the opposite. We're going to talk about the fact that a missed pivot on a daily chart is a signal that a trend is coming. Once again, a missed daily pivot in the world of currency trading, you could do this in stocks too, but it's not as effective. In the world of currency trading, a missed daily pivot is a signal that a trend is coming. We're going to turn this trading system on its head now, and we're going to go to part 2. So let's just take a breather, stretch your legs, stretch your bones here. Let's say cute puppy. Let's look at a picture of a cute puppy on the web. There is a cute puppy. That is a super cute puppy. Oh, I want every puppy in the world. That is totally and completely amazing. I want 4. That's exactly the dog that I want. Does anybody else here want a beagle? I want a beagle. Man, that is a beautiful dog. All right, so we're changing directions now. We've split the presentation into 2, and I'm going to talk for 10 more minutes. I think I've got 10 more minutes. I'm going to talk for 10 more minutes about a different trading system that does the opposite. So I want everyone to realize that everything that I'm going to say now is a brand new trading system. It's a brand new trading system. separate from the one that I talked about a few minutes ago. On the screen in front of us, and I'm not going to answer any questions about the previous presentation now, we're moving on. Sorry, we don't have all day. It's totally awesome to talk to you guys. You're the best ever. On this chart, the dollar-yen 15-minute chart, which is also the chart we were using for the weekly pivots on stocks, the dollar-yen 15-minute chart, we can see a blue line on the screen, and an arrow is pointed at that screen, at that mispivot. That's a daily pivot. A daily pivot is created every day in the currency market, on my charts anyway, at midnight London time. For you, a daily pivot might appear when the session opens or at the close of the stock market. Doesn't matter when. A missed daily pivot was not touched by price yesterday. Hey, Rob Valentine's, nice to see you here. A daily pivot was not touched by price during the day that it was created. This is going to be really important. We're totally switching the system now, and we're going to talk about something different entirely. Do you see how immediately in the next 2 or 3 days price fell downward, that it missed the daily pivot and price dropped? That's totally cool, right? That's awesome. We just talked about that. We just had a conversation about that. What I want to talk to you about is the move back up now. Now we're going to combine what we learned a few minutes ago with something completely awesome and completely different, and we're going to talk about Knoxville divergence trading. I took a trip across the country last year in a car, and I slept over at traders' houses for 30 days, and I wrote a book about it. And in the middle of Knoxville, Tennessee, I had a revelation of my own by myself. I had a revelation by myself about a way to trade divergence that I have come to love with all of my heart. It's not great for everybody, but it is great for me. And the Knoxville divergence indicator is freely available at tfl365.com. I'm going to use that indicator right now in the remainder of the presentation. So you're going to hear me talk about Knoxville divergence, and you're going to scratch your head and you're going to say, what the heck is Rob Booker talking about? That doesn't sound like anything I've ever heard of. I'm going to introduce to you or reintroduce this to you, and it'll take us a few minutes. You're going to need, in order to trade what we talk about next, charts, the Knoxville indicator that you can download for free, and your favorite financial instrument, or in my case, the currency market. Knoxville divergence is based on the momentum indicator set to 20 and the relative strength index set to 21. We don't have time for me to tell you how the Knoxville divergence indicator was built. You can download it and you can watch some videos or do some other work with it to find out how that's done. The Knoxville divergence indicator that you can download or subscribe to on tradingview.com automatically plots this indicator on a chart for you, so you don't need to know how it's calculated. Divergence is disagreement between price and an indicator. Divergence is an early warning sign of a possible change in the trend. I love divergence. I have spent my life in trading thinking about divergence. I wrote a whole book about it that is probably my favorite book that I ever wrote. And it didn't sell the most number of copies, but it's easily my favorite one of all of them that I ever wrote. Divergence is something absolutely special. It is an early warning sign of a possible change in trend or change in direction. On the screen in front of you, you can see the Canadian dollar, Swiss franc. You can see price falling. Do you see price in the upper part of the screen falling? You do. You see that red arrow underneath price? What's the momentum indicator doing at the same time? I'm going to ask that question to everybody. Could someone let me know? Just so I know that everybody's here, we're having some audience participation. Yeah, the momentum indicator is going up. That's divergence. That's Knoxville divergence, in fact. Price is falling and momentum indicator is rising. That means that the enthusiasm for selling it has diminished. At the same time, over the course of the same candles, the relative strength index went oversold. That means that we have divergence at the same time that the market went oversold. That's Knoxville divergence. I told you I wasn't going to tell you what it was. I did. You now know what Knoxville divergence is. Knoxville divergence is the disagreement between price and the momentum indicator set to 20. And at the same time that price is falling and the momentum indicator is rising, the relative strength index has gone oversold. That's an indication that price is about to go up in the opposite direction. back up again. In order to do a Knoxville divergence that is bearish, you would simply flip all of this on its head. We don't have time to get into that because the Knoxville divergence indicator automatically plots this on a chart for you, and the indicator is free. You can go to tfl365.com and get the indicators. They're free. I don't care if you ever buy anything from me in your whole life. I don't care. I would prefer that you did, of course. Why wouldn't I? But if you don't, I'm not offended, and you can download those indicators and use them. The Knoxville divergence indicator is identified on this chart by a red line underneath price. Boom shakalaka. That means I want to start buying the shiz out of the Canadian dollar Swiss franc. Now we're back to what we talked about at the very beginning of the presentation. The missed pivot. Miss Pivot. I think Miss Pivot ought to be a new character on Downton Abbey. Miss Pivot. Okay, so if that pivot is missed, we're going to do something extra special now. That's a daily pivot, and we're focusing on the daily currency market now. Daily pivot is missed. What are we going to do? We're going to wait for the Knoxville divergence indicator to print bullish divergence. And someone just asked, I don't know why you need the momentum and the RSI together. Because sometimes there's divergence, my friend, but there's not a market that's oversold or overbought. And sometimes there's a market that's oversold or overbought, but there's not divergence. Knoxville divergence incorporates both. I never, ever, ever said, and remember this, I never said that it was a magic weapon or it was absolutely a sure thing. All I meant to say was it's an indication or a suggestion that price is about to move in the opposite direction. So we know that we have the missed pivot. And then a couple of days later, we get bullish Knoxville divergence, a line underneath price. And then we're going to buy the US dollar Japanese yen. So after price has already made that attempt to get back to that daily pivot, we're going to buy it. We're going to buy the ever-loving crap out of it. If you download the Knoxville divergence indicator, you'll also get the reversal tab. A reversal tab is another indicator that I built that is a conversation that we can have separately at another time if I ever get invited to do a webinar with anybody ever again. And after today's webinar, I'm not sure that's ever going to happen. We don't have time to get into it today, but it's automatically included in your download, and I want to teach you the system more than I want to teach you what that's based on. It is based on the moving average convergence divergence, and I'll get into it later. There's nothing hidden. I don't have any secrets, and I'm happy to unlock the code and all that other mumbo jumbo. Let's look at some examples. The dollar yen misses a daily pivot. The dollar yen misses that daily pivot, and we can see bearish Knoxville divergence pointed downward. We're going to ignore it. We're totally going to ignore it. We're totally going to ignore it. But we're going to wait until later on after that was missed. We're going to wait for bullish divergence or a reversal tab pointed upward, and then we're going to buy it. For example, let me show you this example here. Dollar Japanese yen missed daily pivot. The daily pivot was missed. You could see here at the bottom of the screen, the blue line was not hit by price on the day that it was created. Price makes an attempt to fall back down toward that daily pivot. It might not get all the way there. It might. It makes an attempt to go down. And then it prints bullish Knoxville divergence in two places, and we buy it both times. We buy it both times. And then we're going to ride that up. If you get a McAfee warning on my website when downloading the indicator, you don't have to worry about it. There's nothing wrong with the website. I promise you, that is a weird warning if you got that indicator, and McAfee has its brain lodged upside its little computer bottom. You buy it both times, and a stop loss can go underneath the pivot. And we're going to buy it upward. And it's going to do a giant shoot upward. That's what happened next. Now, this is, of course, a well-placed example. I'm showing you one that was profitable. It's not going to work every single time, but it's going to work enough that it makes a lot of sense to trade this. On the screen in front of you right now, you can see a missed daily pivot, a blue line on the screen on the left, and then you're going to see Knoxville divergence line. As soon as those lines are completed and formed, you're going to go ahead and you're going to take a buy trade back up. I'm going to put a stop loss underneath that daily pivot, and we're going to ride that back up. Here's a US dollar Japanese yen, missed daily pivot, and then we get a reversal tab, and we get divergence. We buy it immediately on that divergence. Now what happens if we're already below the daily pivot? We can put a stop loss below the divergence, and we're going to try to ride this back up. Someone said, do you play the downside first? And the answer is, boy, I have so many different ways to use these pivots. There's so many different ways, and today we just don't have enough time to get into them. The answer is yes, but we don't have time in this presentation. So I'm going to give you some statistics. Let's just stop for a moment before we conclude, and I'll give you some statistics. The euro Japanese yen, for example, since November of 2006, had 1,844 pivots. I loaded data into Microsoft Excel until my computer got slow. It had 1,844 pivots. Within one day, 72% of those, or 1,333, were hit. Within 7 days, 89% of them were hit. Within 30 days, 94% of them were hit. Within 120 days, 97% of them were hit. On the dollar Canadian, the statistics look almost exactly alike. Most pivots are hit within a certain amount of time. So if the left-hand bar on the screen is the total number of pivots in the last 7-8 years, you can see that most of them get hit. Most pivots are hit. Most pivots aren't missed. Pivots are important, in other words. No, that's just an old equity curve that we don't need. Our Canadian dollar. Missed daily pivot, and then we get a reversal tab, arrows pointed downward, and we sell it a couple days later. Once again, you can go to TFL365.com for the indicators. Once again, daily pivot here, a bearish reversal tab, we sell, divergence we sell, reversal tab we sell, and then we ride that downward until we're into some profit. All right, so I'm going to conclude my presentation now. We're just about out of time. I have a lot more to share with you about pivot points, and I'd love to do it. If you want to go to j.mp/marchmystery, and I don't have this written down anywhere else. This is actually the only place. I am not ready with the rest of the stuff about these pivots. But if you want to just put your email in at marchmystery, j.mp/marchmystery. If you want to put your email in there, it just asks for your email address and your first name. I will send you information tomorrow morning. I'm going to do a self-serve online video that you can purchase. It's not going to be free, but it's not going to be expensive. And you can get the rest of this information in this presentation. We'll continue this presentation on for about 2 hours more, and we'll talk about trading back to those daily pivot points. We'll talk about the reversals. We'll talk about trading to a weekly pivot in the middle of the week. So if you go to j.mp/marchmystery, I had to think of a name for it. I'm sorry, it's a stupid domain link, but that's the only one I could think of 5 minutes before the presentation began. And I realized before the presentation began, I was never going to finish my presentation. And so I would, somebody says that doesn't work. March Mystery doesn't work. Oh, that's just terrible. /March Mystery. No, that works. You're incorrect. So http blah, 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 j.mp/marchmystery. I want to just say thank you to Fausto. I'd consider Fausto a friend. It's not like we hang out every weekend and go get beers or whatever. Although if we lived next door to each other, then we would. But I couldn't afford to live next door to Fausto, so that's not going to happen. But that guy is awesome, and he hosted this thing for free, and WebEx costs like $12 million. So I just want to say, everybody, if you could just say thanks to Fausto, that would be great. I really appreciate him inviting me here today. I know I caused a little bit of a ruckus, and for some of you that like to get to the heart of the issue, I know I can really annoy some of you. And thanks for hanging out with me for a while, everybody. I appreciate the time. Fausto, thanks so much for having me on. And that concludes my presentation.
Rob, thank you so much, and hopefully everybody's enjoying. Yes, I'm Fausto Pugliese back again, and once again, Rob Booker is a very good friend, and I'm always happy to have him on again, and we will have him back again. We always, if he's around, I mean, obviously you can see the guy's all over the place, all over the world. So you actually got me a little nervous because he logged in like 3 minutes before the meeting because He's wherever he is, somewhere in this world. So it's always a pleasure. Great content, though. You know, it's pretty funny, though. And when I teach my classes, which Rob was also talking about pivot points, you know, one of the big things I do kind of use is pivot points. And, you know, and there's things that you need and things you don't need. You got to be careful with a lot of these charts and indicators and everything, because they are big laggards. But there are certain things that you do need. And remember, what makes pivot points is supply and demand and buying and selling. But there was a lot of great lessons. And listen, even me being a good trader as I am, you know, I always pick and learn something also myself. So it's great that you guys are here, and it's been a pleasure having Rob in the meeting. Now, our next speaker we have is